when you get into passive investing, you first have to have an immense sense of ownership. You have to flip your mindset because you are now the steward of your money. And which means you have to know what you want, why you want it, and who do you have to become to go get it. And in this case, you need to understand your goals. Do you need cash flow? Do you need equity build? Do you need tax benefits? Do you need diversification? Do you need some sort of blend of all of that?
This is episode 72 of Keeping It Real Estate. Today, we have on the show Whitney Elkins-Hutten, and Whitney is a partner in over $800 million of assets, including multifamily housing, mobile home parks, single-family rentals, assisted living facilities, car washes, self-storage, just about every asset class out there. Whitney is also the director of investor education at passiveinvesting.com and host of the show Passive Investing Made Simple. Today, everyone on this show is going to learn a lot about how to get started in passive investing and the different asset classes that Whitney is involved with. So with that, thanks for coming on the show, Whitney. I really appreciate it.
Yeah, absolutely. Thank you so much for having me on.
You're welcome. And with that, why don't you share a little bit about your background and yourself and how you got into investing?
Absolutely. Well, I'm currently the director of investor education here at passiveinvesting.com. And, we're a private equity firm that helps high net worth individuals invest in private equity real estate, specializing in multifamily self-storage, car washes, hotels, and first position lien real estate debt. But that wasn't what I went to school for. I actually started off came out of college with a degree in chem and biochemistry, and you went into public health. And, it was just, this was actually dating myself like post 9/11 and, bought a house with a significant other. And, about a month later, the relationship fell apart. And here I was, a homeowner and didn't know what to do in order to pay all the bills. I was traveling about 70, 80 hours a week. And I was like, I need to figure out how to get this thing unloaded or make it a profit center for me. So I stuffed it full of roommates who didn't mind living in the middle of a construction zone. And we got the rehab done. Traded a lot of rehab for sushi, beer, pizza. And about 11 months later, I sold the property, which was probably my number one investing mistake. And it wasn't until that time that I realized I made more money with that one single transaction that I did for working a whole year in my day job. And that's when I was bitten by the real estate bug. I did several more of those live and flip and house hacking projects alone, and also with my husband, my current husband. My only husband, by the way. If he listens to this, I don't have any other husband. So I have to just clear the record there. But long story short, I saw the avenue for me to be able to unlock those golden handcuffs, that paycheck dependence. But I didn't quite know how to, I could create value, but I didn't know how to create cash flow, because it's not until you understand how to create stable, reliable cash flow that people feel very comfortable with removing stepping away from their day job and purely living off of the income that their assets generate. And I tried several different ways. I went into single family investing, small multifamily investing, all of which got me closer and closer to where I wanted to be. But it wasn't until I got into larger institutional grade assets, owning them in partnership with partners, either actively and or passively. That's when my eyes were wide open. Like, this is a real possibility. Now, only one of those gives you an ROT, a return on your time. And that was the passive real estate investments. And so then I just doubled down to figure out how quickly can I take all this money that I'm earning actively, either trading time for dollars or in my active real estate investments, and funnel it to the other side of the cash flow quadrant, as Robert Kiyosaki calls it, and invest in passive real estate, invest in other people's deals to really unhitch my time from how I earn money. And so fast forward today, just personally, I have 6,500 residential units, 2,200 self-storage. I think you went through those stats. And we actually help people do exactly that at passiveinvesting.com.
That's incredible. I mean, what a journey. You house hacked your first rental, stuffed it full of roommates. My wife and I did a very similar thing. We bought our first house. We had 4 bedrooms. We put, friends in 3 out of the 4 bedrooms, and kind of got addicted to the cash flow and, the equity that we were building in the house. So I love that you did that. I love that you explored, different avenues. I would love to hear more about, how you figured out how to cash flow on assets, because it sounded like you were doing some single family flips, maybe some single family rentals. You weren't cash flowing. When did that switch happen? And was it by switching asset classes altogether, or were you doing something different with the investments that you were making?
Well, so there are several inflection points on our journey. And, the first one is we were doing these live-in flips and house hacks. And so, we're young, married, new marriage, and we're still living with roommates. And we're kind of like, well, I don't know about this. So it wasn't until we actually moved into a rental right before kind of like the downturn in 2007, 8, 9, that we kind of got quote unquote stuck in that rental. We were a little fearful to sell because we didn't know what our next project was going to be. And so that happened. And then, so we're sitting here and on our latest flip, and then we understand that we need to start generating cash flow. So somebody was like, well, hey, why don't you start don't split these, hang on to them and put a renter in it and generate cash flow. And you were like, oh, this is how everybody else has done it. Why not do it that way? So it still wasn't quite transparent for us. So we had a lot of cash built up on the sidelines. And so we're like, well, hey, let's not trade our current property. Let's go invest in this cash and see if we can just buy a rental outright. So like most investors who start getting in single family, you think your backyard is the greatest thing since sliced bread. Like there's no other way that real estate can be profitable in any other market, right? You have the blinders on. So we did exactly that. We bought we sunk about $80,000 into a property, and it cash flowed a little bit. It cash flowed $400 a month on an $80,000 investment. And we were like, okay, this works. We're getting cash flow. And then the tenant called and said, oh, by the way, the toilet broke. And we're like, there went that $400 that month. The next month, the fence blew over. There went that $400 that month. And then I stumbled across a little website called Bigger Pockets, and which they start teaching you there, like, how do you analyze a deal? And I'm like, here's the funny part, Mike, is I actually have a degree in epidemiology, which for people who are like, epi what? It's essentially a statistics degree. I knew math. I just didn't know how to apply these skills to my real estate investing. And so I just devoured the website like in a few days. And then I kind of picked up my head and I looked at my husband. I'm like, oops, we are not going to smoothly hit our goals if what we want is cash flow. And presented my case. He's also a very scientific and math-oriented person. And he was like, what do we do? And I'm like, well, according to this forum, we can't sell the property for another year unless we're going to get hit with capital gains. Because now we no longer have the 121 exclusion working for us. We have the 1031 exchange, a whole other topic here. And but we still had some cash sitting on the sidelines. And I'm like, well, let's go invest out of market. And of course, he thought I was completely nuts. And sure enough, we did. We started testing out a couple markets, Indianapolis and Kansas City. And that really started to prove very reliable for proving to us that real estate does actually work in other markets. You can invest from a distance. I mean, we just live 20 minutes from our rental property here in Colorado. And due to traffic, I didn't want to go visit it.
Yep.
So I was like, well, what difference does it make if I live 20 minutes from it or like 20 hours? I just need to find a team. So anyways, it was very enlightening to us to start building this portfolio out of state. And then I was just at month 11, I was just chomping at the bit to get this house sold because I knew I could immediately not only like quadruple my cash flow with that trade, but I could also figure in property management. So I
Mhm.
also got my time back, a little bit of my time back. I still don't consider, investing single family investment with a property manager to be 100% like getting your time back, but you're more leveraged in your time. Anyways, that was kind of the impetus for us in trying to figure out, oh, this is cash flow. This is what we really need. And funny enough, Mike, it just wasn't intuitive to us. We really had to get, I guess Jim Rohn says you're the average of the 5 people that you hang out with. It wasn't until I started hanging out with a community that said the words cash flow, equity growth, that I could actually put my finger on what it is that I needed and what I wanted in my life.
That makes total sense. And rewinding a bit, I love how you said you had the blinders on in your local market. And I think there are so many people, including myself, when you first start investing in real estate, you think that's the only way. And, really what you need to do is take a step back and look at the fundamentals, look at the population growth, look at the business growth, look at how landlord friendly the state and the city is. And all of those different metrics are going to play a massive role on how successful you are. And like you said, even if your property's in your backyard, half an hour away, that doesn't mean you're going to go and visit it every week or a couple times a week. You might visit that property less than something that you own out of state. So I love that pointer. I loved how you got, you went from flipping homes to actually holding properties and underwriting them properly. So that way they did cash flow. I'd love to dive into the asset classes that you're now investing in. As we stated at the beginning of this podcast, you're in a lot of different asset classes, which is really interesting. What asset classes do you love the most, and has that changed over time?
It is, yes, it's changed over time, but it's also been in response to the market cycles. And so I think a couple of things here. I think investors are, are chasing yield in, especially in today's market cycle. And there's risks to that. But if you're open to diversifying your portfolio, and because there's always going to be some asset class that has the yield because they don't cycle together. Yeah. So you have to be willing to almost introduce that diversification into your portfolio. Now, to rewind it a little bit, I didn't set out to invest passively. I didn't look at my portfolio and said, okay, Mike, I'm going to do 25 in multifamily, 25% in self-storage, 25% in car washes. I didn't look at it like that. I honed in on multifamily real estate, went full force into that for like 3 or 4 years. Why? Because one, the market cycle timing was amazing for that asset class. Still is very solid. Don't get me wrong. Multifamily is still a very incredibly solid asset to invest in. But two, I had the translatable skills. It was an easy leap to get from single family investing into multifamily investing, just like it is for somebody to get owning their primary to getting into single family investing. It's not a big pivot, but to go from owning nothing and to go into institutional real estate, that's a huge leap, right? Mm-hmm. So really kind of, moving the needle. And when I felt I understood one asset class, I would start learning about another. Now, I never set out to be the expert in additional asset classes. I knew that of myself, that I would just be diverting my attention or dividing my attention, really. And so, really, I sought out the experts in this space. So to come back around, what asset classes do I like right now? I still really love multifamily. I think it's a very solid asset class. There are some nuances, I think, right now that we could discuss about how to get involved in multifamily real estate. Two, self-storage is still a very solid hitter in this type of environment, especially since we're still only about halfway through the market consolidation from, this big money getting in the space. A lot of people think we're way further in this cycle. We're not. We're about halfway through. And then I really love car washes, express tunnel car washes for a myriad of reasons. It's a cash intensive business, a cash flow business. And there's a lot of opportunity to take these things that we've learned from the self-storage space, the technology that we layered into the self-storage industry, and apply it to car washes. But you have to own the land and own the brand. There's some very specific ways that you need to own car washes. I'm not a big fan of franchises. There's no right or wrong way. I'll just put it out there, because I know a lot of people love investing in franchises, but for me, I want to think of this as, what is the exit? How can we get to IPO quicker? What would make attractive exit to, say, like a large private equity company or a REIT? And that is owning the land, owning the brand, controlling the end-to-end vertical of it, which means you also have to own the property management or invest in the property management. And guess what? Right now, there is no property management for car washes, and that's what we've been able to solve in the space as well, is bring in third-party management.
That's great. Very interesting asset class. How long have you been in the car wash space? And, do you see a lot of opportunities, across the nation in that space?
Yeah. So we, at passiveinvesting.com, we entered the space about a year ago,
Okay.
opened our first investment. It's a little over a year ago. So do we see an immense amount of opportunity? I mean, most car wash locations express car wash locations are owned by a mom and pop owner that has less than 5 locations. And they probably got into the industry thinking, oh, hey, I'm going to invest my capital. I'm going to open a business that has a lot of operational efficiency, and then I'm going to be able to take a step back and not be, wear the COO hat. Well, it's simply not true. You have to scale to about 10 locations in order to bring in a regional manager to start managing across those locations. Most mom and pop owners never got there. Okay. They never even got to the 5 to where they can even bring on somebody part-time. So there's a unique opportunity to take this very fractionalized business and start consolidating it. But it means you have to solve some specific problems here. One problem is consistent branding, right? How do you build a large, recognizable brand? That's something that we have a very unique strength at. We've already done it in the self-storage space. We've done it in the multifamily space. We bring those same strengths into the car wash space. We own the land and we own the brand. That's what differentiates us from franchise ownership, where you don't own the market share, right? Like you have just like your little market area that you can market to, and you can't step over somebody else's market share in the space. Other things, unique things to solve. I mean, there's always, how do you create additional streams of income and operational efficiencies? One unique thing with how do we increase income is that we move our clients or customers from single pay car washes to monthly recurring revenue. And so we just a subscription agreement, kind of like Netflix, right? You move them, you don't rent just one video at a time at Blockbuster. If anybody here remembers Blockbuster, you do monthly subscriptions, like all these other MMR related companies, or MRR, sorry. But anyways, long story short, that provides stabilized income throughout the year, but also increases the value of the business immensely. And then you have that third-party management piece. Again, big money doesn't want to get into the space quite yet. They're chomping at the bit to, but they don't want to, because what REIT, like, is Blackstone really going to pick up 10 car washes and try to operate them themselves? No, they want to pick up car washes and they want to place it with third-party management that doesn't exist right now. We've built the first third-party car wash management company, and we're focused on our own locations, and we're acquiring 250 to 300 locations in about 3 years.
That's amazing. Well, congrats on all the success in that space. Very interesting space. I truthfully have never talked to anyone, that's been in the car wash industry, and especially allowing that as a passive investment. I'd love to talk a little bit more about passive investing. I think a lot of our listeners are interested in that space and, want to know how they can be successful being a passive investor. So, when investors are looking to take the passive route, what are some of the beginning steps that they should take?
Oh, goodness. I got a whole process. And so I'm going to lay it out for everybody at a high level. We can dive down each one in the categories deeper, wherever you think your listeners will want to go, Mike. But I invite everybody to go to passiveinvestingwithwhitney.com, because everything I'm about to say is in an ebook that I have for you at that website. So the first thing is, as a passive investor, I mean, just think about it. I don't know about you. For me, I was cultured grow up, get a good job, go to college, get a good job, invest in your 401k. And once you do that, in order to hit retirement numbers, you kind of have to invest in the higher yield assets, maybe a little bit of balance with bonds in there, but, swing for the fences on your stocks, balance with bonds, cross your fingers and hope everything works out. That trains us to do two things. One, completely outsource all of our decision-making to somebody else, some sort of behind the screens wizard and mutual fund advisor, right? Two, it trains us to chase yield. So when you get into passive investing, you first have to have an immense sense of ownership. You have to flip your mindset because you are now the steward of your money. And which means you have to know what you want, why you want it, and who do you have to become to go get it. And in this case, you need to understand your goals. Do you need cash flow? Do you need equity build? Do you need tax benefits? Do you need diversification? Do you need some sort of blend of all of that? You need to understand your risk tolerance. For a profile for somebody who is 20 years old, it's going to be very different investing profile than somebody who's 5 years away from retirement, right? And the 20-year-old can probably do more development deals and swing for the fences because they have time to recover. Whereas somebody closer to retirement is probably more focused on cash flow and tax benefits, as part of their portfolio build. And then you have to understand your investing horizon. Okay. Now, there's no one size fits all solution. I know 20-year-olds who are cash flow intensive. I know, 50-year-olds who are swinging for the fences on development deals because they have to make up time very quickly. Anyways, once you understand that, now it boils down to three things that you can control: who you invest with, the operator, where you invest in, the market, and then three, the deal. And so now this paradigm takes, you notice I mentioned the deal last. Right? This is very counterintuitive to what we've been trained to do with our stocks, bonds, and mutual funds and our 401k and retirement funds. We were trained there to look at the deal, like swing for the fences on the chase yield, right? We have to flip that on its head. We have to take ownership on building those relationships, on finding those people who are experts in their space. Now, here's the amazing thing, Mike. Once you find an amazing expert that has assets or has a investing theory that aligns with your goal, your risk tolerance, and your time horizon, things get a little easier, okay? Because now you can concentrate on these 3 or 4 people that you fully vetted, love, and trust them. You understand their business, their track record, who their team is, all the value they bring to the table. And once you fully have those people vetted, and I keep using the word vetting, this isn't like asking your friend, who did you invest with? Do you like them? Okay, great. I'm going to write somebody a check. No, you need to do your own due diligence. Like, again, things get much easier once you have a core team that you can invest with. Then it boils down to, do you like the market where that deal is? Is it I love growth markets where the population's growing, incomes are growing, jobs are diversified, landlord favorability laws, landlord or business tax laws are very favorable. And then it gets down to the deal. Does the deal itself, each individual deal you go into, help you get closer and closer to your goals, right? Now, you can vary your portfolio a little bit, maybe equity deals, debt deals, stuff like that, but you need to have eyes wide open what your goals are and make sure those deals align.
I love that. And I love your order of importance. Who are you investing with? Get to know them on a personal level, make sure like and trust them. Where is the deal at? Pay attention to the market and then look at the deal. And I loved how you mentioned, know what you want and what your goals are. I think a lot of investors and people out there don't really take a step back and take a look at what they want and what their goals are, where they are in their investing timeline. So I think that was some great advice, Whitney. I'd love to hear a little bit more on how do you see short-term and long-term, or what's your short-term and long-term outlook on the real estate market? Obviously, there's a lot going on right now. What's the crystal ball look like in the next 5 years?
Well, my crystal ball is broken, and it's not because I think that the market is going sideways or south or going to like boom or anything like that. It's because I take those things into account. I look at them. I keep my finger on the pulse, but really I'm I've trained myself to invest based on principle.
Yep.
And so what are those fundamentals that I need to look for in every single asset that I go into to ensure that if the market goes up, down, or sideways, that I'm making some sort of return? And that's really, so the whole point of investing is to not get knocked out of the game. Okay, if you can stay in the game, eventually you will win in some form or fashion. It's only when you get knocked out that you can no longer play. Right? I don't know. My daughter's new favorite game, we used to play Exploding Kittens, but now they have a layer on top of that. It's called Zombie Kittens, which now she loves because it brings you back into the game. So, but anyway, so the whole point is not to get knocked out. So really, I look for assets. And I'll answer your question more directly, but I want to impart like a little wealth of nuggets here. The 7 pillars of wealth. Look for assets that preserve capital. That's why I love real estate. That's why I love businesses. And even more importantly, businesses and real estate combined. That's amazing. I look for assets that cash flow today in today's economy, right now. Like, I don't, for me, I'm okay taking a little bit less cash flow right now if there's a clear, strong business plan to grow that cash flow over time. Okay, because I know cash flow is compressed right now. Equity building, right? There's market appreciation, which we really can't affect, but is there a plan in place to increase income, decrease expenses, and add additional streams of income? Why do we want to look for that type of business plan? Is so that we can actually grow the net value of the asset. We have some sort of control over the growth. This is one of the reasons why my portfolio now isn't as heavy in single family real estate, because that's based on comparable sale. Now, I still love controlled real estate. I still love having those assets that I can manipulate and manage and use as little mini ATMs to dump into my passive investing. I will never tell anybody, get rid of all your single family real estate, right? That's not the point here. And then assets that have tax benefits that take advantage of depreciation, accelerated depreciation, bonus depreciation, operators that have every intent to do a 1031 exchange. How can I continue to use depreciation as a tax shelter, but kick my tax can down the road? And then smart use of leverage, right? Leverage, we are seeing it in today's environment, right? Gone are the days of 3.5% fixed interest rates. They've popped up, and we're seeing people get really hurt, over the past 2 or 3 years that have invested in assets that had adjustable rate debt with no cap on it. Okay. And so leverage can amplify returns and it can amplify losses. It cuts both ways. So you need to, the debt is almost the most important part of the asset these days. And then, again, invest in assets that have good inflation hedge. You can look at that 2 ways. One, you're locking in your expenses today, your loans today in today's dollars, if you expect the dollar to continue to devalue. But also, how can you adjust that asset's income and expense ratio, the OPEX ratio, as inflation occurs? And then the last piece, that I always put in there, the wealth pillar, how can I amplify myself, right? I personally can only do so much as an investor with my own active investments until I have to build a team underneath me or go invest in somebody else's team. So again, we've looped back to that investing with very strong operators. Now, where are we in the market? I think we're in a unique position still. Asset prices are still pretty high compared to what operators can actually want to pay for those assets. Now, it has changed, since, late 2021, where you saw a lot of operators actually pay that high asset price, overpay on an asset, $5, $6, $10 million, thinking that the tide's never going to go out. Well, the tide went out.
Yep.
But you haven't seen the sellers. There hasn't been a huge amount of softening on asset prices. I think we're going to see that a little bit. Every, economist I've read out there, thinks that, interest rates are going to kind of normalize, stabilize a little bit, maybe start ticking down. I think those are some things to really take a look at. One thing that is very true is, for operators, and people that bought assets with adjustable rate loans that didn't get a cap or have no way of extending their debt timeline, that bill's coming due. And a large part of them are going to start cycling out this year, but start coming due towards the end of Q3, Q4 of this year. So I think there's some unique opportunities for people who are sitting on the sideline in cash.
I completely agree. I think there's a lot of, like you said, adjustable rate debt. And some people, I've heard upwards of about 30% of those loans that were placed didn't have rate caps, which, that's a significant amount of properties
Huge.
that are probably in a pretty tough position, because you went from paying 3% to maybe 7 or 8% now. And that's a big increase. So I couldn't agree more. You had said you like assets where you can kind of set yourself up for success, whether the economy goes down, whether it goes up, whether it goes sideways. Are there any tips or strategies, that you've implemented to make sure that you're doing that? Is it on the debt side? Is it on the team that you're putting into place? Are you able to share a little bit more there?
Yeah, so just the methodology and how you're underwriting your deals. And I think, that's why a lot of us love real estate, because if you are, double checking your deal, essentially checking the box in each one of those categories, even if the cash flow distributions are paused on a deal, as long as the business plan to push the equity is sound, the cash flow might eventually come back, and you're going to make money on the equity. You're going to make money on the tax benefits. You have capital preservation, as long as, the loan was, right. Like, so there's some things to manipulate in here. Mm-hmm. So for me, it's just a matter of being very methodical on when I underwrite a deal and making sure it checks as many of those wealth pillar boxes as possible.
Got it. That makes sense. And that kind of plays into my next question here. I wanted you to share some tips or strategies for really maximizing returns and minimizing risk when it comes to passive investing. So is there anything specific that a passive investor can do to mitigate risk, or, make sure they're getting the best returns possible?
So, the biggest risk mitigation for a passive investor is understanding who they are investing with. Mm-hmm. So, and making sure that person that you're investing with, their deals are aligned with your goals. Yep. That's where I see a lot of people getting into trouble. And me personally, I had to learn that lesson, kind of the hard way myself. Like when I first started getting into passive investing, I took this cultural training that I had as far as chasing yield, and I brought it into that space as well. Fortunately, it was in a timeline, part of the market cycle where I didn't get, bit in the rear end too bad, but, really having those investing rules essentially, and you can ask other investors what their rules are, maybe borrow some of those rules, but there's no one size fits all solution. Everybody has to understand what their personal rules are. Mm-hmm. And so I actually just did a webinar on my masterclass, Passive Investing Made Simple Masterclass, which is a weekly webinar. I do a monthly boot camp where I teach people an actual skill in the space. And the last skill we covered is how to track your portfolio. And so I led everybody through a process. And you and I both know portfolio tracking can get very wieldy, but I walked them through a very simple process to begin to look at their portfolio. And then really understanding what is your total net worth allocation per deal by operator and by market. Mm-hmm. And having complete visibility on that, and actually beginning the tracking process before you ever write the check into the deal. And so a lot of people, they're like, oh, there's a deal open, I got to get my commitment in. And which may be true. It may be kind of a race to the wire scenario, but make sure you take the 60-second process to just enter one line on your tracking spreadsheet and make sure you have not violated your investing rules, and create those investing rules for yourself while you're clear-headed and you're not in a pressure position to write a check.
Exactly. I absolutely love that. And, if you start tracking up front, it's going to be so much easier than jumping in 2, 3, 4 years down the line. So great advice there. Whitney, I really appreciate you coming on the show today. If anyone wants to get a hold of you and learn more about what you're doing and how they can get involved, what's the best way to get a hold of you?
Yeah, absolutely. You can reach out to me at passiveinvestingwithwhitney.com. And there I have a free ebook that goes over much of which we talked about in today's episode, but also you can get access to my calendar and we can talk all things real estate.
Perfect. Well, thank you so much, Whitney. I appreciate it.
Thank you.
Remember, passive investing is an extremely smart way to build long-term wealth. To learn more about how you can get started, click the Contact GTAG link in the podcast description and fill in your information so you can start creating passive income today.